I always attribute it to Warren Buffett, the napkin math. If you can explain your business on the back of a napkin, you have not really distilled it to the core of what you're trying to do.
Even as we move into the world of AI and everything's digital, you come into my office and it's just sticky notes everywhere.
You have the sticky notes around your screen, like
Oh yeah.
People make good decisions on the pennies, but really bad decisions on the pounds.
I have this vision of the person who brings their lunch to work every day, but then they lease a car for $1,000 a month.
It happens more often than you think.
You had thrown this framework at me, Empower. What's the Empower framework?
It's a very formal set of tools that we use to make sure that we don't keep decision-making in the company at the executive level, but we infuse it in as many parts of the company as possible.
Is this thing on?
Yesterday's price is not today's price.
Welcome back to Run the Numbers. Today I'm joined by Bruno Annicq, CFO of Wellhub, formerly Gympass. Someone who didn't set out to be a CFO, but ended up building one of the most thoughtful finance playbooks I've seen. Bruno's path runs through McKinsey and AOL, but what really stands out is how he shaped the finance function at Wellhub around 5 core principles. Manage for cash, drive sustainable growth, avoid surprises, act as a true partner to the business, and keep things simple. These aren't just slogans, they show up in how his team plans, allocates, and communicates across the company, which we get very tactical on. The heart of this conversation, though, is forecasting with AI. How Bruno moved Wellhub from a deterministic model to a more probabilistic Ensemble style approach, and what that shift unlocked. We get into why most finance leaders are still too anchored in single scenario thinking, and how to actually structure a probabilistic forecast, and how to make it usable for people across the company, not just finance. Finally, we touch on his Empower framework for annual planning and how to set OKRs that people don't immediately ignore. Oh, and how finance and HR alignment on well-being is becoming a lever for long-term employee retention. All this and much, much more after a short word from our sponsors. Here's a growth tax nobody talks about. Every new monetization model you ship creates a nightmare for your finance team. Add usage-based pricing? Now you're tracking consumption against commitments. Launch product bundles? That's multiple performance obligations per contract. Offer mid-cycle upgrades? Woo! Good luck reallocating revenue manually. The irony is brutal. The pricing innovations that drive growth are the same ones that often break your finance process. But that's exactly where RightRev shines. RightRev is the revenue recognition engine built for companies that can't afford to let accounting slow down growth. Here's what most people miss, and I've come to deeply appreciate. Revenue recognition isn't just a finance problem. It's a go-to-market enabler. When your rev rec is automated, your product team can ship new pricing without asking finance for permission. And your sales team can close creative deals without worrying about downstream chaos. To get up on my CFO soapbox for a sec, I love talking about creative pricing models, hybrid pricing, credits, tiered usage. It's where real growth happens. But I've seen too many companies where the sales team is celebrating a huge quarter while finance is still trying to figure out how to recognize half of it and crying in the corner. RightRev lets you experiment with pricing without wrecking your close process. And honestly, in a world where your pricing model might change 3 times next year, that flexibility is everything. If you want to scale your monetization without breaking your books, visit RightRev.com. That's RightRev.com, where modern monetization meets bulletproof accounting. Being a CFO, you know how much I love tools that actually make the lives of accounting and finance folks easier. One of my favorite tools right now is Rillet, the AI-native ERP going head-to-head with NetSuite. Yes, someone is finally doing it. I met Rillet 2 years ago when they were still in stealth. Since then, they've absolutely taken the finance world by storm. Their mission is to make the zero-day close a reality, and they're actually doing it. Customers are literally closing their books at 1:35 p.m. on the first day of the month. They've got everything you need to scale your business. Complex revenue recognition, native integrations, custom reporting, multi-entity, close management, and much more. They're only a few years in and are already supporting NASDAQ publicly listed companies. Yes, seriously. If you want to scale your business on an ERP that wasn't built in the 90s, you need to check out Rillet. Book a demo at rillet.com/CJ. Oh, cool, that's me. That's RILLET.com/CJ. RILLET.com/CJ. Tell them I sent you there. This next segment is brought to you by Tabs, a company I've been following closely for quite a while. And if you're a CFO or controller listening, this is one you should pay attention to, because this is where billing and revenue automation is headed, especially in a world of usage-based pricing. Ali and the team at Tabs are building something that directly addresses one of the biggest headaches I see finance teams deal with today. Pulling data from your ERP, your CRM, your FP&A tools, and your usage systems and actually making it all work together. If you're running usage-based pricing or complex contracts, you already know how this usually plays out. Contracts live in one system, usage data lives somewhere else, billing happens in another tool. RevRec gets layered on top at month end, and finance ends up just reconciling everything by hand to close the books. It works for a while until close slows down, RevRec gets fragile, and wait for it, cash shows up later than it should. This is exactly the problem Tabs was built to solve. Tabs is an AI-native revenue platform built for controllers and CFOs. It brings together data from your ERP, CRM, and real product usage into a single system of record. From there, it automates billing, collections, and revenue recognition without finance having to duct tape workflows together every month. No CSV uploads, no manual reconciliations, no end-of-month fire drills. Companies like Cortex, StatSig, and Cursor are already using Tabs to scale revenue per employee, save hours every close, recognize revenue cleanly, and get paid faster. If usage-based revenue is core to your business, this is the future of how billing and RevRec get done. Go check them out at tabs.com/run. That's tabs.com/run. Bruno, thanks for joining me on the podcast today.
Happy to be here. Looking forward to it.
So during our discussion, we're going to dive into your CFO frameworks and Wellhub and how you've leveled up your forecasting. But I first want to start with your path to the CFO seat. I think this is pretty funny, but when we were preparing for this, you described yourself as an accidental CFO. So how does that happen?
I came up with that term because unlike most of my peers who I feel like were born and came out and said, I want to be a CFO. I love the numbers. That's what I want to do. They go to college, started at one of the big fours, and then end up being a CFO. And I never really knew what I wanted to do when I grew up. Out of college, I decided consulting is a great kind of continue my education. I worked at McKinsey for a while, did my MBA, and then only when I had kids, when I was traveling a little bit too much, did I decide, okay, what am I going to do with the rest of my life? And I knew I didn't want to do strategy because I'd been doing that for a while. I wanted to be a little bit more diversified. So I chose operations. I did some work at AOL, which is one of my clients. And then to a variety of kind of a very meandering path, let's put it, I ended up in the eyesight of or eye line of somebody who was the CFO of AOL at the time, came from Verizon when they purchased us and said, hey, why don't you do finance? And I was a little taken aback. Me, finance? I don't know. Not nearly enough about finance to do that kind of as a real job. But I think she saw something in me. I'm very grateful to her for it because as soon as I started doing that, I was a divisional CFO at AOL. I really liked it. I like the numbers. I always liked the numbers, but I liked actually being closer to the numbers, helping shape the numbers right to capital allocation, and then telling the story the numbers show. And so once I got a taste for it at AOL, then when I had an opportunity to be kind of a proper CFO, say in a private equity-backed company, I jumped at the chance, and then through a few more jumps here and there later, I ended up at Wellhub, and I've been doing it for almost 6 years now. And I can't see myself really doing anything else.
It's funny. So I started in the consulting group at PwC straight out of college. And I think it was more because I didn't know what I wanted to do, but I thought it would look really good on paper and I would get some at-bats at seeing interesting business models. And so I found my way to the CFO seat too, but I don't think it ever once popped into my head in college or even in a couple years after college. That's where I was trying to get to.
Very similar. I thought consulting is a great way to keep learning, right? And you see many different businesses, many different models. Maybe I'm not as accidental as I think I am.
Yeah, I found it fascinating, but in many respects, I felt like a financial tourist. And I was popping in, popping out, but I didn't really have true skin in the game. Startups, I think, were my product market fit.
I like the kind of mid-sized private equity-backed companies where you have real finance functions, real product. Like I have almost more than 100 people now in the finance team. So it's sizable, right?
6 years at McKinsey. That teaches you a thing or two about surviving, I think, the PowerPoint mines. What stuck with you most about managing your time and priorities? Because I hear that you are a ruthless prioritizer.
It was very interesting because McKinsey, you're focused on one problem at a time, really, right? And you get a lot of time to work on that problem. And I was typically working 100-hour weeks, which I don't quite do anymore. So there's a lot of time spent on that specific problem. And then when you get to the real world, you realize, wait a minute, there's 1,000 things to do. There's 1,000 day-to-day things I have to keep up while investing in the things that really matter. And I'm a big believer in the Eisenhower matrix. I don't know what you would call it, but the urgent and the important. And making sure that you're not just working on the urgent, but you spend time on the important that's not urgent. I take that to heart. And also, whenever I'm talking to people, especially people that are earlier on in their career, is make sure you spend your time on something that's important but not urgent. And the easiest for me was always the first thing you do in the morning, make sure it's not the urgent, make sure it's the important. And then the rest of your day can get taken over by the urgent. But I found that a really helpful tool to make sure you're working on these things that have long-term payoffs, but short-term might be seen as taking time away from something else.
I think earlier in my career, I wish I concentrated on networking a bit more. It's only when you want to go get a new job, you're like, oh, I should be networking. But it's like, okay, that ship kind of sailed probably 6 months to a year ago of laying the groundwork. So that was always something to me that wasn't necessarily time sensitive, but it was very important. Can you think back to any things that you've worked on, either in the recent past or just in your career, that you said, hey, it's probably something I should pick up now, even though the alarm clock isn't going off to work on it?
I'm sure we'll talk a little bit about the forecasting work we've done here. That's something that I wish I'd made more time for before and earlier, because it has such an outsized impact on how we run the business. It's funny you mentioned networking is something that I'm also not very good at, and it doesn't come naturally for me. So very much agree that it's something that I always say, hey, I should spend more time on networking, on meeting people. What somebody helped me with a long time ago was, it's really easy to spend time with the people you know, or the people that you already have relationships with. And kind of he helped me be very deliberate, kind of make a map of who you want to spend time with and who you should be spending time with. And often you find that the overlap is not 100%. So making sure that you're redirecting your time towards what matters is really important. So yeah, being deliberate maybe is the best way to think about it.
This may sound maniacal. During COVID, I had this aha that I only was close with the people that I worked with, and we had all worked at multiple companies together, which is a great thing. It meant that we all got along and found value in what each person was doing. But it was at that point when I wasn't in the office anymore, I was like, oh, I feel kind of vulnerable about not knowing enough people. So I actually wrote out in January of 2021, and I put it on my fridge. I wrote out the 12 months, and then I put in 2 lines to try to meet 2 people. At first, it was kind of hard, and it felt kind of weird to be writing that down, but I wanted to keep myself accountable. And eventually, I stopped writing it down because I was meeting somebody new once a week.
The act of writing something down makes such a difference. It's only recently that I've started saying, hey, if you have a specific goal, especially outside of work, because for work, I tend to write a lot of things down, but outside of work, and you don't write it down, it doesn't happen. But then once you write it down, it's like you're surprised yourself often because, wait a minute, I just have to actually formalize it, right? And then it's something that you really do. So I love kind of putting it on your fridge or wherever you can, where it's visible and it reminds yourself every day.
I'm a big sticky note guy. I think even as we move into the world of AI and everything's digital, you come into my office and it's just sticky notes everywhere.
You have the sticky notes around your screen, like the...
Oh yeah, with inspirational quotes, with reminders of when to pick up the kids, everything.
That's great. I love that. I'm not a sticky note guy, but my wife is, and I always make fun because her computer is full of sticky notes. I was like, why don't you use the tools? But it doesn't matter what the medium is, as long as it works and it gets the behavior you want, 100% for it.
So Bruno, I want to talk about AOL for a second here, because this is such a fascinating point in your career. So the company itself was at a crossroads when you joined. It was, I would say, post-glory days, but still packed with media firepower and such a catalog of valuable media assets. What drew you in, and what did you take away from navigating that kind of reinvention?
The quote that came to mind, or when you just said this, is Owen Ryan, who was the head of IR for AOL when I joined, fantastic guy. He had this quote that he used with analysts, and he said, AOL, we're the cockroach of the internet. You think we're dead, but we're going to outlast everyone.
Yeah.
And I just love that mentality of like, hey, no, we're the underdog, but there's a lot of great things happening behind the scenes. And I mostly joined because, as I mentioned, I was looking for something post McKinsey, and AOL was a client. So I'd worked with Tim Armstrong and the executive team as a consultant, and I really loved the people. It's a phenomenal team that I joined. It was a lot of fun. They were hardworking. It's a very sales forward company, as you can imagine, right? Tim was running sales at Google before, so there's a lot of kind of sales DNA. And I joined in an operational role, helping to drive the sales teams and the media sales teams. And so I loved the opportunity just to work with great people at a company that was going through a lot of change. You want to work at a place where there's lots of change, because that creates so many more opportunities than in a place where you're kind of on this rigorous path where it's very clear you have to wait 3 years for the next promotion and the next promotion. No, like I go to a place where there's lots of transformation happening, because you'll find the next opportunity well before you're potentially ready, and you won't even know what it is, but you're going to keep pushing yourself, keep learning. And that's exactly what happened. So I couldn't have been happier when I joined, how much change there was, how much I was able to participate in that. And then, as I mentioned, when Verizon bought AOL, there's probably a lot of research on why they bought AOL. But at the time, a lot of it had to do with the platform side of the business, which nobody really talked about. But AOL had a DSP, so a demand side platform, and a supply side platform that they put together to really help drive ad sales from a trade desk or something similar basis. And that was the growing part of the business. And so I was part of that. And it was great to be doing something where there was a lot of excitement, but that was kind of behind the scenes. And people always said, wait, AOL, that still exists? But yes, it does.
I think it just got sold again, maybe a month ago.
So it got sold. Then Verizon bought Yahoo. I left. Then ultimately, I think they took AOL out and sold it. It never quite made sense to me why Verizon would own an asset like that, unless they were really going to double down on the digital ad side, which they never really did. And so I think now it's probably quite different than it was before, but the people were phenomenal. I had such a good time working with everyone there.
Hey, thanks for listening. We'll be right back after a word from our sponsors. Now, if you listen around the numbers, you know that I have a love-hate relationship with finance tech. We've all been burned. We've all bought that enterprise planning tool that promised the world, only to realize 6 months later that we've basically taken on a second full-time job just to keep the software running. I want to talk about a company that was built specifically to kill that cycle, Abacum. I actually remember my very first conversation with their founder and CEO, Julio Martinez, over 3 years ago. Back then, they were just starting out in Spain. What struck me most was his frustration with these massive legacy planning platforms that had long implementations, expensive consultants, and after all that work, you're still struggling to get answers and manage the system. He and his co-founder, Jorge, are both former CFOs. I knew I liked those guys. Fast forward to today, Julio moved the home base to NYC. They've raised over $100 million in capital from heavy hitters like Scale Venture Partners, and they're the engine behind finance teams at Strava, Replit, and JG Wentworth. When a company like Strava, where the data volume is massive, trusts you with their planning, you know the tech is robust. But here's why I really like them. Abacum doesn't turn you into a software admin. The integrations are actually self-service. You don't need a $300 an hour consultant to plug in your ERP or HRIS. And they're doing AI in a way that actually impacts the things FP&A teams are doing every day. Things like creating variance summaries, building formulas, and modeling scenarios. If you're scaling fast and you're trying to avoid that legacy platform trap, Abacum is the move. They're building the future of our tech stack, and they're doing it with a CFO's perspective. Go to abacum.ai to see it for yourself. That is abacum.ai. Well. Here's what nobody tells you about being a CFO. You'll spend 50% of your time on stuff that is killing your momentum. The best CFOs I know are business leaders who know how to drive growth in heroic fashion. But most of us end up spending our days buried in manual work. I'm talking about collecting receipts, reviewing expenses, and manually reconciling spend. It's painful. That's why CFOs need Brex. Brex built an intelligent finance platform that pairs corporate cards with built-in expense management, plus a team of AI agents to handle the manual finance tasks for you. That way, CFOs have more time for the high-impact projects that drive growth. You know, the shit actually worthy of your CFO time. Bottom line, Brex is automating hundreds of thousands of hours of manual finance work every month across 35,000 companies like Anthropic, Coinbase, and DoorDash. Ready to spend less time buried in expenses and more time driving results? Check out Brex at brex.com/metrics. It is brex.com/metrics. Please, guys. How the hell do I have 3 kids in daycare? Brex.com/metrics. You just launched your new AI product. The new pricing page looks great. I'm talking crisp. But behind it, last-minute glued code, messy spreadsheets, and running ad hoc queries to figure out what to bill. Customers get invoices they can't understand. Engineers are chasing billing bugs. Finance can't close the books. Well, with Metronome, you hand it all off to the real-time billing infrastructure that just works. Reliable, flexible, and built to grow with you. They turn raw usage events into accurate invoices, give customers bills they actually understand, and keep every team in sync in real time. Whether you're launching usage-based pricing, managing enterprise contracts, or rolling out new AI services, Metronome does the heavy lifting so you can focus on your product, not your billing. That's why some of the fastest growing companies in the world like OpenAI and Anthropic run their billing on Metronome. Visit metronome.com to learn more. That's metronome.com. Something you said, Bruno, struck me about taking on opportunities at a place where you'll get a chance to step up. And I could see from your resume on LinkedIn that you got promoted a number of times at AOL and in pretty quick succession. And it reminded me of, we spoke to Craig Conti, the CFO of Vera Mobility, a publicly traded company in the transportation space. And he was saying, kids graduate college now, everybody wants to go work for Cursor, or they want to go work for the hottest startup. He said, go work for the paper mill that's about to shut down. Go work for something in like the real economy, or go work for something where it's not all up and to the right. And I'm by no means saying that AOL is a paper mill. It's one of the preeminent tech names of the early 2000s. But there's something to be said about where can you get the most chances to prove yourself and the fastest learning curve.
100% CJ. And I think what I was looking for was new skills, right? I felt like I'd really learned the strategy skill set at McKinsey. But what I saw a lot of my peers, the typical path out of McKinsey was actually to go, there's a big sales ops track in Google where you work with the sales team and you kind of support the sales organization, which is a great path and obviously a phenomenal company and many people there did well. But I felt like that was too constricting. You're kind of there's a long line of people above you. You're working ultimately for a former McKinsey partner who's essentially doing the same internal consulting work that you were doing at McKinsey. That wasn't that interesting to me, right? Or a very popular kind of off-ramp too is to go work for a big strategy team at a Fortune 50 company, right? They all have large strategy teams staffed with former consultants. So I was like, I'm going to be doing the same thing that I was doing before. No, I want to learn something new. And to your point, if you do that in a place that's constantly changing, where people are moving, businesses are being melded together because there's potential turnover, people are laid off, it creates opportunity if you're willing to face the challenge that, hey, maybe you won't have a job 6 months from now, but also maybe you'll get promoted every 6 months, which is what ended up happening to me. So I fully agree with that idea, like that there's so many more opportunities if you're willing to leave some short-term upside on the table, right? Because the bet I was making is as I broaden my skill set, later on, I'm going to be able to build a more kind of robust career because I have more things to fall back on.
Like in the short term, like you said, you give up some of the potential cachet, you give up some of maybe the upside. But I think there's this medium term arbitrage opportunity where you're a smart person and they're just throwing stuff at you. And by doing that, you keep getting promoted. And then when you go to look for your next job, it's like, wow, this guy's, I'm just making it up. He's a CFO at 31 or something like that. Like, okay, cool.
It's the curse of the capable, some have talked about, right?
It's a good line.
If you're capable and hey, we need somebody to man this thing. Like at some point I was running the Salesforce.com team. Like I'm not a Salesforce.com expert, but I was running that team because they needed a home and I did it for a year and a half or something. And then I passed it on. Great experience. Like I'm so much better now at technology because I've seen how hard it is. It was messy and complicated, but you see what these tools are really all about and it's not easy.
All right. So you're a multi-time CFO and you've said that you've carried these 5 principles for finance with you for a very long time. For the benefit of listeners, can you rattle them off for us?
Sure. So the 5 are cash is king, sustainable growth, no surprises, finance as an enabler function, and finally, less is more.
So cash is king. Make that one real for us.
In the end, cash is the most important thing that we do as finance and really what happens within a business. It's really easy to lose sight of what's happening with reporting, accounting rules. It can get messy. And obviously there's good reasons for everything the way it works, but especially for us as a partial marketplace business, I think you alluded to in some of your prior podcasts is cash flow can change quite a bit within the month, right? So reporting just a monthly number is actually not nearly enough for you to understand the business. And what I found and what I actually love is that one of the first things I do when I join a business is I want a daily cash number. Give me the balance at the end of every day and send it in an email. And you can do it by country or by bank account, et cetera. And I've learned so much about the ins and outs of a business, the rhythm, what works, what doesn't work. You catch surprises much earlier because you're like, hey, what happened here? I didn't expect that. And it's such a great way for you to get up to speed on the business. But even now, in a business like that's as mature as Wellhub, I still love seeing it because I love seeing, hey, the cash accumulation, is it happening? Where is it happening? What are the intra-month cash flows that are maybe that we should look out for or that maybe we want to think about financing differently? So it's been a great tool and I love the simplicity of it because that takes almost no work, right? Just have somebody look at the cash balance at the end of the day and just send it around to the team.
I love that. And I think that's the inside baseball that people honestly come to the podcast for. These things of how do I ramp up when I'm in a new job? And Something so simple, but you get the rhythm down and you're living the cash balance day to day.
It's the lifeblood of the business, right? You don't go bankrupt because you're not profitable. You go bankrupt because you run out of cash. And so for me, that's always good to keep an eye on. Like nobody's ever going to be upset that there's too many metrics around, hey, how's our cash doing today?
You can be profitable on a triple adjusted EBITDA basis, but you may be cash poor.
Yeah, the adjusted EBITDA is everybody's favorite, right?
Drive sustainable growth. What's that all about?
On the software technology side, ARR is obviously one of the most important metrics. And I love seeing, especially net change in ARR. So are you growing your ARR? How much are you growing? How much is it coming from new business, existing, et cetera? And the sustainable growth for me is all about, you want to make sure your net change in ARR is much higher than your net change in expenses. I make that my number two because first of all, cash matters. But number two is if you think about the teams around the company, how do they prioritize? What do they look for? What should they think about is like, hey, make sure your expense growth is much more moderate than the growth we can achieve in net ARR or gross profit, whichever metrics you want to use. So that's the sustainability of the growth, is that you're driving leverage in the business, right? It's really easy to grow net ARR if you're growing your expenses even faster.
All right, now we're cooking. Next one here, no surprises.
So this is all about forecasting, and I have a lot to talk about in forecasting, so maybe we save that one for later.
Finance as an enabler.
This one sometimes is controversial because I've had quite a few discussions. I see the finance function, we are a supporting function, right? There is no need for finance if there's no business, right? And so I want to be a finance team that's not a team of no's, but a team that's yes and. How can we help support the business? What can we do to make the business move faster? So I really want us to be a supporting part of the business. There's a lot of education that can happen from the finance side as well, because I think sometimes people don't understand the macro drivers of the business, what works, what doesn't work. And so one of the things that I've used quite a bit is I have two young daughters. When I joined the company, they were 6 and 8 or something like that. And I used the lemonade stands in the summer, and I used to use pictures of them during the lemonade stand and then talk about the economics of the lemonade stand. It's like, hey, here's how to think about the business and what happens when you do X, Y, Z. People will remember that still, and it's a great way for something to, I think, stick and really for people to understand when we say no, why we say no, and how we can turn that into something that we're like, hey, what are you trying to achieve? How can we make sure it works and it continues to drive to that sustainable growth?
The lemonade stand. Life really does just come back to running a lemonade stand, right? Like just don't spend more than you make.
My daughters don't pay for the lemons and they're not gross profit profitable. Let's put it that way.
Next one here, less is more.
This is a broad one. You can interpret it as like, hey, we need to work with fewer resources as we scale. So you have to automate, you have to be efficient. I also really believe that I always attribute it to Warren Buffett, but I don't know if it's him, is the napkin math. Like if you can't explain your business or a new business idea or a new venture on the back of a napkin, you have not really distilled it to the core of what you're trying to do. And therefore, I think there's more work to be done. So for me, that applies to us as a business. How can I explain what we do really simply and the business model behind it? But also when we're looking at new investments, like what's the P times Q, how does it work? It's on us to try to tell that story really simply. And if you can't do that, that's the hardest thing to do, right? It's really easy to write a long letter. It's very hard to write a short letter, right? I forget where that quote comes from.
That was a quote I was going to use. Yes. Sorry, I didn't have time to write you a shorter letter.
I think that the work is on us as finance because in part, I think we're storytellers, is to write that story really simply and shortly. And so when we're talking to investors, new investors, existing investors alike, how can you tell the story as compactly as possible, but still give them the dimensions they need to understand what's happening?
Yeah, whenever somebody gives me a 57-page deck, I kind of in the back of my head say, okay, you may not actually know this as well. Like you're just trying to bury me under these papers because you can't explain it to me.
Yeah, you're doing this service to the reader, right? Because you're putting the onus on them then. Like it's for you to figure out what's important. And it's like, no, I should help you figure out what's important.
Out of these 5, which has been the hardest to get a company in general to stick to in practice?
The less is more is the hardest because it's kind of the urgent and the important I was talking about. How you build infrastructure that can scale, how you make investments now that won't pay off maybe in the immediate future, but will pay off later. So I find that one is really the tricky one. By ranking them from 1 to 5, they're ranked by level of priority. And so number 5 is the one that people might not spend enough time on.
That's beautiful. I'm going to steal this framework and write about it in my newsletter. So thank you.
Great to read and actually much more information dense than many of them, the ones I receive. So
thank you. That's very kind of you. I want to jump into forecasting and planning here. So for those who are still trying to kind of find their forecasting sea legs here, can you break down the differences between deterministic forecasting and, I'm not going to be able to say this word, I always mess it up, probabilistic forecasting. Yes, I got it.
So the way that when I joined, right, and it's how I typically do it, you look at what the next year, the next quarter is going to look at, and you create the most likely path, right? You pick the path where you think you're going to end up. Maybe you have a few scenarios, a conservative case, an aggressive case, but that's really what you're doing, right? You're building kind of a forecast based on of where you believe the business is going to be and your best guess. That works really well, especially for a SaaS business, right? Because you have pretty good visibility in what's going to happen on the existing base. You should have good visibility on what's going to happen in new business based on the number of reps, et cetera. So that works quite well. But our business is a B2B business. We sell a platform to clients or companies, but then on top of that, we have a B2B2C marketplace. So once we sold our platform into companies, their employees can then sign up for one of our plans and can then use our partner network, and we pay them based on that usage. So think of people giving us a monthly subscription, the employees paying us a monthly subscription, and then us paying partners on a variable basis. So there's a lot of matching we have to do. The challenge is that as the utilization of the marketplace is variable, it's really important to predict that well. What we obviously know is that the usage of the marketplace very much depends on what we do, which partners we have, right? How well we are able to activate employees and subscribers within the company. But there's a lot of external factors. Like, believe it or not, the weather plays a huge role. In some countries, when the weather is bad, nobody goes to the gym. In some countries, when the weather is bad, everybody wants to go to the gym because it's indoors. And so there's a huge variability in what happens. And especially in the short term, it's really important we get that right, because at the scale we are, being off by 1% is tens of millions of dollars, right? So we want to be right. And so we use this metric called MAPE, which is the mean absolute percentage error, to look at how accurate are our forecasts. We were about 9 to 10%. So we were, I would say, pretty far off. And the only reasonable way then to plan is to be very conservative. Basically say, I'm going to forecast the worst possible utilization because then I'm going to at least have a benefit. But that might mean that you're not investing in the company as much because you're anticipating that usage will be higher. And so you won't be able to do that extra investment or buy a company that you want to buy that would be complementary, et cetera. I do a lot of water sports. Wind is really important. And if you look at how the best wind apps show you what the wind is going to be, the forecast for the wind is, they don't show you one line. There's an app called Windy, which is a great app. It will show you the actual output of the different models. For weather forecasting, there's a big North American model. There's a European model. There are great forecasts that are very strong locally, but not as good kind of at the macro level. There are longer term forecasts that are good long term, but maybe not in the short term. What this app does, and I love the visual of it, is it shows you essentially different lines for the output from these different forecasts for the wind speed and the wind direction. The value of that to me is when I look at that and I see tomorrow at 5 p.m., the wind is going to be, say, 15 knots from the east, and all the forecasts are close together, I can have a lot of confidence that it's going to be 15 knots from the east. But as some often happens, it might show, no, some forecasts think it's going to be 20 knots, and some forecasts are saying it's going to be 5 knots from the west. As a result, I can attach a lot less certainty to that forecast, and that's a very valuable input to me, right? There's a lot of the forecasted capabilities. We want to use machine learning and some of the more advanced tools we couldn't do ourselves. And so what I asked is, let's find multiple vendors and have them build competing models for our business that we can run in parallel. And so we're using 4 different models now that were developed by 2 different vendors independently that are predicting where our business is going to be. We then put those together. We can see where the models agree, where they don't agree. And then we put our own kind of finance lens on top. And it gives us a lot more confidence in what the forecasts are going to be, what the band of certainty should be, and how we can make sure that we're tightening essentially this error that I was talking before. Used to be 10 is now around 2 or even less. So significant improvements. And also, it was a lot of fun to do and to see the outcome of it. And it was also, I think, a great way to take advantage of the very different methodologies to forecast. Like, there's lots of great machine learning models, but some of the challenges are you can't explain what's happening inside those models, right? They'll say this is what's going to happen, but it can't tell you why it's happening. And by having multiple models, some of which are more explainable, you can kind of, that model is saying that it's probably because of these drivers. And so it helps with the explainability as well.
This is amazing. Okay. So, wow, what do I dig into first here? Did you say you went from 10% down to 2% variability?
Yes. And I would say not 100% of that comes from just the fact that we are using multiple models. I would give a lot of credit. The team also got a lot better. I have a phenomenal team. We actually got them from the consulting companies now have their own big data teams, right, that are really comfortable in Python and are using kind of the most advanced models. So they can do a lot themselves. But the new models that we built on top really allow them to to take new inputs and basically add it to make their own forecast better. And they're all learning models. So every week, every day of data we get and we rerun the models, they get better because now there's another data point that they can use to build and improve the forecast set.
And when you say you're running models, this is going to come across as a stupid question, but not all teams are running as fast as you are. How do you separate the software you're using from the underlying model? Do you have one core planning module that you use and then you have large language models under it, or how do those work together?
I hired people that can talk in the native language of the people that build these models. So mostly they use Python. I'm not a specialist either, but there's different modules within Python. And so when we hire a firm to build a model, we insist like, no, I want you not to just give me the output and something that's a black box. I want you to feed the actual model, and I want you to teach my team so they can keep this model up to date. They can add dimensions to it, et cetera, and they can retrain it over time. And so that's the way it's working. So it's a team that's working at the most granular level that was already doing it for us, but now they have kind of new models that come on top and they keep running them in parallel and they're able to maintain it. It's not like an Anaplan or something that's running on top, right? We use that later in the pipeline, but the actual work is being done at the most granular data level and mostly in Python.
Where does the word ensemble come from? Because I think that's a beautiful way to encapsulate it.
Well, you know what happened is I was trying to figure out how to describe this, and I asked ChatGPT, how would you describe it? And it was like, well, it's a multi-model forecast, so it's an ensemble forecast. I was like, thank you, ChatGPT.
I can totally visualize the weather apps that you're talking about too, with the different lines converging in the same places. It's not like just one answer. You can see the direction it's going in.
And it's so fascinating to see when they agree and when they don't. And it's like, especially when there's a more extreme, like people are predicting like a lot of wind. You can see that when there's more variability because it's outside of the normal, right? And they don't always agree on where it's going to come from and how it's going to hit. You can see that with hurricanes as well, like the cone of predictability, although that's just giving you the range, not the actual, I want the lines of the models. I love seeing the actual lines of the models when a team present their forecast.
So the big risk is people get models that they think are more accurate, but they become less explainable. Can you explain to us why explainability is so important?
Especially in a marketplace where you have some control over what happens, you want to understand what's driving the behavior so you can potentially create alternatives for that behavior if the outcomes are not what you want, right? I think for us, I love utilization. I love when people go visit our partners because it's good for them, it's good for our partners. But if there's abnormal things like fraud is a good example, or people take advantage of the model in a way that you weren't expecting, like you want to catch that early. And usually by having more explainability, it helps fighting the root causes or identifying what the root causes are. We have a fraud team that can go, they don't need to look at the complicated models. They're like, hey, the dimension to go look for is this one, and they can double down on that.
That's amazing. Well, great job to your team there. I know we're wrapping up annual planning season for many of the people listening. You had thrown this framework at me, Empower. Well, what's the Empower framework and how does Wellhub use it?
I am not going to do it justice in this the time I have here, CJ, but it could be a good topic for a follow-up because it's something that we've spent a lot of time on as a company, and it's not unique to me in finance. It's something we've created as an executive team at the company, and especially our chief of staff spend a lot of time. It's a very formal set of tools that we use to make sure that we don't keep decision-making in the company at the executive level, but we infuse it in as many parts of the company as possible. And so the roots of it are the ROSI framework, so the responsible, accountable, you've heard of it many times. And so making sure that every project, every decision, or every kind of area of work has somebody that's accountable, and it needs to be one person, can't have multiple persons, because if you have multiple people, it doesn't work. Or if you have nobody, it's not going to work. We have a strong framework for how do you solve conflict, what happens if people disagree, how do you allow that to bubble up so people can make decisions fast and it doesn't slow people down. We use OKRs and the key results within the OKRs as the prioritization for the company as a whole. And so there's a tremendous amount of work on how do we make sure when we make a decision, we empower people that are closer to that decision to then run with it and make the subsequent decisions. And then how do we make sure that when we prioritize, we're not just prioritizing as a leadership team, but we're prioritizing with as many people in the company as possible. So it's very external. Everybody should always know what are the top 3 priorities for the company. If they're making a trade-off in their kind of own day-to-day, how can I make sure that I'm supporting those top 3 decisions, et cetera? So that's proven really helpful. And then for me in finance, I can attach to that, right? I know what the company priorities are. I will change a few, like I will always add cash, right? Because for me, cash, as I mentioned, is really important. But I will make sure that the rest of our priorities are aligned with what the company's trying to do so we can be that enabler for the business, as I mentioned earlier.
At many companies, the finance team is essentially the keeper of the OKRs. What have you learned over your career about where OKR setting goes right and where it goes wrong?
I think it has to be a joint decision. I think we can be, in many ways, the police for it.
Exactly.
But if we are making decisions, yes or no, on what people can or cannot do without a framework for them to understand or a framework for them to help us optimize, you're essentially putting the decision of thousands of people in the hands of hundreds of people without really enabling them to move faster and to align with your priorities, right? A big reason why I have my 5 principles is I want to make sure that everybody in finance understands how I prioritize and they can prioritize accordingly. And to us, the Empower framework is the exact same. We want to give transparency to the company. Hey, here are the priorities that we agreed to with the extended leadership team of the company. Here's why we agreed to them. Let's make sure there's plenty of opportunity for people to give their feedback. But then once we set them, let's all run. And then that's the same framework I'm going to use to say yes or no after the fact. It should never come to me. If I'm saying yes or no, I feel like I failed because I should have empowered my team to make those decisions.
Bruno, when it comes to employee wellness, what does it actually look like when finance and HR teams align around well-being in a way that drives real business results? It's not just rah-rah and morale points.
One of the big challenges that I've seen is that finance and HR might not feel like their metrics are very aligned, but increasingly they are, right? They're very much on the same page because I see one of my biggest expense lines is people, right? That's by far the biggest. And then within that, one of the fastest growing expense line items is cost of healthcare, especially in markets like the US. And so I'm spending thousands of dollars per employee per year on healthcare. And on top of that, that's growing 15, 19, 20% per year over the most recent year. So helping HR figure out, hey, how can we make sure that we have the best, most motivated people that are also healthier so we can make sure we don't spend a fortune downstream. And so a lot of what we're talking to companies about is like, hey, don't look at what HR is doing as an expense, look at it as an investment and make sure that you're investing in things that can have a meaningful, positive outcome, again, in the medium to long term. And we believe only 4% of the investment in healthcare in the US is actually going towards prevention. 96% is going towards treatment, which is an insane number, right? And so if we can help companies spend a little bit more on prevention, but as a result, lower their cost of treatment, the outcomes are extremely positive. And we've actually done some really interesting research with clients where we've taken more than 10 clients now, and we've taken their actual health cost data, so the actual claims that they had for their employees and our Wellhub usage and put them together, obviously using a third party because very sensitive data. And we can clearly show that if people are active at least once a week on Wellhub, that's the trigger, there's a material difference in the health cost of the people that are doing that activity versus people that are not within a period as short as 18 months. So it doesn't take that long. It's quite powerful, and it's one of the main ways that you can bend the curve of health cost increases.
My chief people officer would bring the cost or estimated cost of healthcare to me at the end of each year, and our headcount was not growing that fast. And it outpaced the double digits, whatever our headcount growth was. I could never make sense of it.
And it doesn't matter if you're self-insured or not, right? If you're self-insured, you're still seeing the same because the cost of treatment is just going up, right? That's what you're seeing across the board. And if that's 96% of your spend, nothing you do is going to make a material difference in trying to bring that down. What you can do is get your people to be healthier and get them to be active in any way, shape, or form. And that's where we come in. We've had tremendous success in getting people that were on the fence, that were thinking maybe too complicated, that didn't want to be locked into a contract to start doing something. You don't have to be the biggest gym rat, right? I'm not a big gym person. I love yoga. I love workouts at home. The key for HR is you want to meet people where they are. You want to find something that works for their lifestyle, where they are in life right now. And so giving them a really broad range of options, which is what we do.
And if 70% of your costs at most tech companies walk on 2 feet, you're investing in your most expensive asset.
And then there's secondary and tertiary effects where we can also clearly show people that are active on Wellhub turn over less, absenteeism is much better. So there's many other impacts of what we can bring to the table and getting your employees to be most engaged. But I think especially with CFOs, the people expense being the largest and healthcare being such a fast growing one, being able to speak the language, hey, I'm bringing you tools that are going to help change the growth of that cost, I think can be quite powerful and is what's been resonating really well between CHROs that are really well connected with their CFO.
So well-being used to be in that nice to have column, but now it's becoming more of a strategic priority. It's even showing up in company OKRs. As CFOs start thinking more long-term, where do you see well-being landing in the broader financial strategy for many companies?
We see CEOs increasingly say that they see a really positive return on well-being, and it's important to their own strategy. But I think the way that I've always thought about it is, as a CFO and as an investor in some of the tools that enable a business to be more productive, one of the most important things for me is that there's a real skin in the game in the tools you're buying. And what that looks like if you sell SaaS and you give your SaaS tools away for free, you're actually not going to see much adoption because people didn't really buy into the tool, especially if there's an effort to implement, right? Because they're never going to implement and never going to use. And for me, it's the same in well-being. You want to give people skin in the game. And that's why when you look at who's actually paying for the benefit of Wellhub, it's not the company. Most of the cost of what they use the product for is actually borne by the employee themselves. And that's really critical because it means that the employee is paying for their own well-being and therefore is much more incentivized to actually do something, go out, go be active. And as a result, you as the company are going to see the benefit. So we're not trying to sell this as hey, this is a gold-plated benefit where the company needs to be responsible for everything. No, we're saying you as a company have a unique opportunity to invest in the platform to give your employees access. And once you do that, you're going to see significantly higher uptake within your employee base of people that are participating in it, paying for their own usage. And as a result, you or the company are going to see the benefits just as much as the employee who obviously is healthier.
I think that having skin in the game, having to pay something for it, that clicks. And I think there's a lesson there for companies who have completely different business models.
You want to be bought in from the beginning, right? And I like adding that friction in the sales process essentially early on, because you as an employee, when you decide, hey, am I going to buy a plan? You have to think about am I going to spend the $20, the $100, depending on what plan you buy? Am I going to spend that this month? You're essentially making we were joking about putting notes on the fridge about what your commitments are. You're making a commitment no, I'm going to do something. And then if you make it a great experience where people they like what they do, they feel that they can enjoy the variability. They don't have to be committed to one. They don't feel have to worry about being locked into a specific plan they can't cancel or pause while on their vacation. You're lowering the threshold and they do it again and they do it again. And then you get the really positive outcomes that I think are what our employees or the subscribers, as we call them, are looking for. But just as importantly, HR is looking for because they can see the benefits in engagement and in lower healthcare costs.
That's awesome. Bruno, I'm going to take you into what we call our long ass lightning round. I ask every successful CFO who comes on the podcast, give us an example of something you've screwed up on the job before. It could be here or any previous role.
I was thinking about this, and one of the things that came to mind is I think quite a few of the people before talked about patience and being patient. And I'm actually going to go the other way around. I regret not moving fast enough. Change is hard. A good example is the forecasting changes that we talked about before. That took a while to implement. But if my only regret is I should have started earlier. And there were always reasons not to do it. There was no budget. The teams were busy with other things. And in hindsight, we could have done this a year earlier and had better outcomes as a result. And when you feel like there's something important, just push for it. Because if you think it's important and you don't push it, it's going to get overtaken by the urgent, right? As we were talking in the beginning.
There's something to be said about injecting a sense of urgency into the organization, even when there isn't something screaming that needs to be done today.
If the dividends pay off much later, the longer you wait, the longer it takes. And then everybody knows about compounding returns. If you're working in businesses that are growing really quickly, your compounding returns add up really quickly, right?
Next one I got for you. If you could tell your younger self something knowing what you know today, what would you tell them?
That's a good question. Actually, I love asking that in interview questions, what advice people would give themselves when they join a company. The opposite of what I was saying before is it's not patience, but it's enjoying where you are in the moment. I feel like everybody's been in places where they see people around them get promoted or do really well in their careers. And it's really easy to feel like, hey, why am I where I am? Maybe I should have made different choices, right? What you lose sight of is that where you are has a lot of merit in of itself. And I think when you think about what are all the things I would like to achieve in life, maybe more broadly, you don't need to wait as long as you think, right? Because they're obviously not monetarily focused. And so to me is make sure that you're enjoying the journey maybe and where you are instead of focusing on what's the next step, what's the next thing that I'm going to do. If it's a quiet time at work or there's something happening, take advantage of the fact that you don't have 100-hour work weeks, right? And work a little bit less. So then you have the crunch for a close. You can put in that extra time because you recharge your batteries. And so I think that's really worthwhile.
I'm never good at it. And I actually made a change this morning though, and leaned into appreciating the moment and taking a bit more time. So I actually went to the gym and I was like, you know what? I'm going to work out for 30 minutes longer and not rush back to work because I had your interview in the afternoon and I was up late working last night. And I'm like, I can't every day, just push myself. This sounds weird, but sometimes I actually have to inject a sense of procrastination that I did take an extra 30 minutes or hour off just to get my mind back on track and to be able to drive at something again.
Well, it's all finding that balance, right? And making sure that I think that you're not just single-mindedly running towards one goal, because I think like you can have many goals in parallel and you're better for it, right?
Yeah, I probably got more done in that hour before the podcast rather than having 2 full hours to work, just because I was like, okay, CJ, you got to get to work now.
There you go.
Bruno, more of a technical one. Can you walk me through your finance software stack? What tools does your team use today to get the job done?
So we're mostly NetSuite as our ERP. We have Anaplan on top. On the FP&A side, Workday is our big HR stack. We use Kyriba for anything on the cash side. Google is most of our infrastructure across the company, so we're using that in many other places, including in finance. There's very little Excel. Everything that's not done in our systems is done on Google Sheets, which I actually have become a fan of. Navan for travel, soon for expenses. Most of the last year, we're doing integrations. We bought some other businesses, and so we're spending less time on new systems and more on figuring out what the new acquired companies are using, and then making sure that we're moving them to our stack. I think the one exception is we're looking at potentially moving to Pigment instead of Anaplan. I think there's a lot of more adapted to what we need it for, and maybe leaning towards more the AI side than Anaplan is, at least for a company at our scale. By the way, shout out to your AI newsletter, which actually was quite good and quite broad. So thank you for sending that, and thank you for doing that work.
Thank you for reading. It almost killed me. Sorry I didn't have time to write you a shorter report, but I did put my heart into that one.
I thought it was quite valuable. I sent it around the finance team, and like a tremendous value you provide to your subscribers that you give that for free. So congrats and well done.
Thank you. It's a labor of love. Last one I got for you. What's the craziest thing you've ever had someone try to expense?
One concept I didn't talk about, but I use a lot too, is penny wise, pound foolish. I feel like people make good decisions on the pennies, but really bad decisions on the pounds. Like people might not buy the latte, but then they lease a car that's way too expensive. So I think about expenses in many ways similarly. I feel if I'm approving expenses, something's gone horribly wrong. And so there's very little I end up seeing. So I don't have really good examples for you. The only thing that came to mind is I think at some point during COVID, everybody got pets, right? So somebody got a dog, and then they realized, oh no, I need to walk this dog all the time, and they couldn't do it. So then we tried to expense the dog walker. And I was like, so we had to say no to that. But again, I thankfully have not seen that many, because I'm hopeful that people make good choices, and then that my finance team is empowered to, if it makes sense for the business, I'm all for it. If it doesn't, then obviously we won't do it. So
I have this vision of the person who brings their lunch to work every day to save $3, but then they lease a car for $1,000 a month.
Like it happens more often than you think, right? I use this a lot in the business as well. It's like sometimes we sweat over a $20,000 investment here or there, but then we're signing leases for $1 million
right.
A year. So like if we saved a little bit there, like we could do all the $20,000 investments we need to do. And obviously when there's a lot of ask for investments with everything that's happening on the AI side, like I think about that a lot. It's like, hey, I don't want to say yes to the small expense, but then have to say no to the big AI investment, or vice versa.
Bruno, this has been an absolute blast. Thanks for joining me today.
Great to be here, and thanks for having me.
Run the Numbers is a mostly media production. Yelling and intro by Fat Joe. Artwork by Meg D'Alessandro. Show is executive produced by Ben Hillman. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog way too much ice cream and has a history of net operating losses. LOL. If you like this podcast, hit subscribe and give us 5 stars. It will take like 2 seconds, and our algorithm overlords love it. Drink water, call your mom, and have a great day.
Peace.